Assalamu alaikum everyone. This is Abdullah Mamun, studied at University of Rajshahi Banking and Insurance Department. The last three digits of my student ID is 154. Today I will discuss about my selected topic, general instructions on capital adequacy framework. So let's discuss about in details. General instructions on capital adequacy framework. At first we have to know that what is capital adequacy. Capital adequacy refers to the minimum amount of capital a bank or financial institution must maintain to absorb losses and continue functioning during times of financial distress. Banks provide loan to customers, but sometimes they provide loan bad customers. So they they need to keep extra reserve involved against the bank loan, which is provide the bad customers. Next, the aim of general instructions on capital adequacy framework. The aim of capital adequacy framework identify the optimal balance of financial institutions, asset and liabilities and risk. That is very important for bank and customers, which is save money in the bank. Next, how to measure capital to risk weight asset ratio, that also called CRAR. CRAR, that's mean capital to risk weight asset ratio. Capital to risk weight asset ratio is an indicator of how well a bank can meet its obligations. The ratio compares capital and risk weight asset. It is to protect it is used to protect depositors and promote the stability of financial system. Next, how to calculate capital to risk weight asset ratio. Capital to risk weight asset ratio or CRAR is calculated by taking eligible regulatory capital to numerator and the total risk weighted asset as denominator. The formula of CRAR, that means capital to risk weight asset ratio equal total eligible capital divided by credit the sum of credit risk weight asset plus market risk weighted asset and operational risk weighted asset. The total eligible capital is the amount of total capital of a bank for a bank. For example, suppose bank ABC has 10 million in tier 1 capital and 5 million in tier 2 capital. Two types of capital are measured. Tier 1 capital is core funds on hand to manage losses so that a bank can continue operation, and second, tier 2 capital, that is a secondary supply of fund available from the asset a bank closed down. So it has loans that have been weighted and calculated as 15 million. The capital adequacy ratio of bank ABC is 30%. So 110 million plus 5 million divided by 50 million. Therefore, this bank has a higher adequacy ratio and it considerably safer because the higher rate of capital adequacy ratio. Higher of capital adequacy ratio. Next, the scope of application. The Basel Committee provide a rate so that commercial bank keep in hand 8% of his reserve for against the bad loan. These guidelines apply to the all schedule bank on solo basis and consolidated basis. Solo basis refers to the all positions of a bank and its local and overseas branches. Next, Consolidated basis. Consolidated basis refers to all position of a bank and its subsidiary company who is engaged in financial activities. So it is all about my side. So thank you very much, everyone.